Have you thought about purchasing an individual stock this year? There's a lot of names out there that have been doing very well. We're giving you 6 steps today to think through a decision-making framework that can help the next time you are thinking about buying an individual stock. Stick around. So today we're talking about the thrill of victory and the agony of defeat with individual stocks. Of course, that's the Wild World of Sports reference. However, we get caught up in these emotions when we're talking about individual stocks and thinking through our decision-making when we're wanting to buy an individual stock and or sell an individual stock. So we had a couple of examples that we've referenced. Of course, we get asked about this often. And an example that I really enjoy, it identified a lot with me, was Amazon, because many of us use Amazon, or familiar with Amazon, maybe have invested in Amazon through the years. In an article I read around the 20th anniversary, it was in 2017, kind of captured this emotional journey and roller coaster that you have to be on in order to benefit from an individual stock. Because 16 of those first 20 years, Amazon suffered a 20% loss. And then if you look back through the years for intra-year declines that you had to go through to get that ultimate benefit, in the tech bubble, it fell around 95%. And in the 2008 decline, it included a 64% decline at one point from peak to the trough in 2008. So that just gives you an idea of what you have to deal with. And Chad and Allison here with you today talking through this idea. Allison, you know that all too well, right, when talking with clients?
Yes. So this is a frequent one we hear. And I think there's a lot of human emotion and biases that come out around this issue, because the path to extreme wealth in most scenarios is paved with an individual concentrated position. We look at Bill Gates, Jeff Bezos, Mark Zuckerberg. What do they all have in common? They all created a company that became extremely successful, and a lot of their net worth is in that company's stock, and it's made them very, very wealthy. So I think there is a feeling that a lot of us have that that was obvious that was going to happen.
Mm-hmm.
We have that hindsight bias that I should have known that, and I missed out on that stock. But I'm not going to miss out next time. I'm going to buy some now and take advantage of this trend that's happening and the changes that are happening in our economy. And I see it continuing going forward, that these companies are going to continue to win. The ones we've talked about most frequently in the past decade have been the FAANG stocks. Obviously, Facebook, Amazon, Netflix, Google, that have done extremely well. And over the past year and a half, it's been Zoom, which has exploded and provided, almost 700% return right now since its IPO in the past 18 months. So, it's tempting. If we could identify those winners and ride the wave, we could make up for maybe those years where we didn't save in our 401k plans.
Yeah, these stories make us feel really good too. And it's fun to talk about to other people when you're around them, if you actually benefited from that. But the fact is, studies show, and history tells us, that the odds are twice as great that you'll go broke on a single stock as you'll hit it big. So looking back, thinking through that idea, you have to establish a decision-making framework when you're thinking through these decisions. And we've come up with 6 steps we're going to talk through today of how you can do that. So you want to jump into the first one there, Allison? It's performing a deep dive of your portfolio.
Sure, that's absolutely correct. So a lot of times when we're thinking about buying an individual stock, our reasons are emotional, and we want to make sure that the framework we're using is based on evidence. We want to go through the evidence. And the first thing we want to keep in mind is, if we're already investing in a well-diversified portfolio of mutual funds and or ETFs, it's likely you already own the position or positions that you're considering. So you want to really do a deep dive and see, do I already have exposure to this stock position? If so, how much? Because it's likely, if it's one of the big names like the FAANGs or even other stock positions, it's likely you already hold some of it. So if you do a portfolio deep dive, find out how much of it you hold right now and how much you've been benefiting from that position along the way. You've likely already been riding the wave of success, but it's been a little bit muted because some of the other things in that portfolio haven't done as well. So diversification is always going to mean that you hate something in your portfolio, unfortunately. Means a smoother ride along the way, better odds of success, but also means, you don't have as much to brag about maybe at cocktail parties with that stock that really hit it big in the short term.
So after we do this deep dive and understand how much we own, we may still feel we want to own more. So the second step is deciding how much you want to
Yeah,
own.
and there are some legitimate reasons to own an individual stock position. Maybe it's a company that you work for, you inherited it, you were gifted it. There might be some sentimental or family value tied up in that position. But what you want to make sure is that you're not buying an amount that has a potential to kill you. Even if you could make a killing, you want to make sure you're not overexposed and it's not going to be detrimental to your long-term wealth.
And then the third aspect here, it's not just about the appreciation and the gain that you're looking at. You got to consider the tax component.
Yes. So we never want the taxes to be the primary driver of our investment decisions, obviously, but you want to think about where might be the best place to hold this individual stock position. So if it does realize the quick gains that you're anticipating, maybe it's better to hold that in a Roth IRA or a traditional IRA where you have either tax-free or tax-deferred growth. Conversely, maybe you're close to retirement and your tax bracket is high today, but you anticipate it dropping significantly when you retire. So that might mean the potential to realize the capital gains at 0% later at lower rates. So we want to take a look at what those positions are, what kind of growth do we expect, and where's the best place to hold them if we are in fact going to make a purchase.
And if you've watched any other videos on our channel here, you understand the idea of how much we talk about a long-term investment strategy and having discipline involved in that. And then of course, diversification being a big part of that. So when you're thinking about an individual stock, if you're adding that to this mix, you have to be able to have target prices in mind of how you may feel when the price reaches a certain high or low and how you'll respond, right?
Yes, exactly. And we talked about, what's an appropriate amount. And our recommendation would be that you keep that 5 to 10% or less of your total portfolio. And if that stock is doing extremely well, that's going to grow in relation to everything else you have in your portfolio. So one, you want to keep an eye on what is the percentage of that holding in relation to everything else. And then two, what's an appropriate price? You might think, because our natural inclination is going to come back to, it's doing really well, I'm not going to sell it. I'm not selling that. That's done so well for me over the past year. But the better it does along the way, the more likely that you have some losses coming in the future. Things that do well in the recent past are not usually the winners going forward. So we want to look at what's an appropriate target price to sell, take profits, reduce risk, diversify.
So after you set these target prices and you maybe have percentages attached to them, if it rises 20% or falls 20%, this is how I'll feel. So it's also important to add a narrative around that and try to think about your emotional aspect, right? And then ask, what if I'm wrong?
Exactly. So we want to think, what could go wrong? And if that does go wrong, we want to make sure that however much you're investing in this position is an amount you're willing to lose, your amount you're willing to say goodbye to, and it's not going to be devastating to your financial plan and you and your family's future.
And then on the other side of things, ask, what if I'm right? Because I think what you were talking about earlier there of the feelings you have, well, that's done so well for me. That's likely the more common feeling if you've had any kind of positive growth there.
Yes. And we talk about on this show before, stocks are the one thing that we want to buy more of when they're expensive. It's really counterintuitive. If we went into the grocery store and milk was $50 a gallon, we wouldn't be loading up our carts buying as much as we can. But that's typically what we see happening in the stock market is when valuations are really high, demand goes up and we all want to buy more. So that's what we want to think about and recognize that even if I am right and the position does really, really well, we have to acknowledge that purchasing and trading in individual stocks is a form of gambling and speculation, and we have to know when to walk away.
So having an investment plan surrounding there, a diversified approach, and then understanding these steps in your decisions around individual stocks can help. That's our goal here, is to help educate, help you think about investing and your financial plan just a little bit differently so that you can maybe pause and add some patience into the decisions before you are acting on pure emotion. We have a lot of other episodes here. You can subscribe so you don't miss the next episode and give us feedback if you have other ideas. This is one we've been hearing a lot, so we wanted to answer this question. Thanks for joining us today.